So, should you pay off your mortgage early or invest that extra money, say, into the stock market? It's one of the biggest financial debates out there. There's strong opinions on both sides. Now, I've done both, so let's break it down side by side. The pros and cons for each strategy, so you can decide what makes the most sense for you. Welcome. I'm Charles. This is One Life, Many Lessons. I want to help you live your best life. First, congratulations, wherever you are on your financial journey. The fact that you're searching for answers puts you way ahead of most everyone else. If you've already paid off your consumer debt, credit cards, vehicles, etc., and you have an emergency fund of 3 to 6 months, depending on your job security, that next big payment is the mortgage on your house. Now, if you haven't, I'll link 2 of my other videos in the description that can help you get there. Stick around to the end to hear what I did and how it worked out for me over the last 26 years. Part 1. Paying off your mortgage early. Well, you get a guaranteed return equal to your mortgage interest rate, but the return might be lower than what you get investing long term. 2. Peace of mind knowing you're debt free, but you might miss out on the wealth building power of compounding. 3. Lower monthly expenses once the loan is gone, but until then, extra cash is locked up into your house and hard to access. 4. There's no risk of foreclosure. The bank can't take your home if it's paid off. But that money is illiquid. You can't easily use it in emergencies. 5. Guaranteed financial freedom. Fewer obligations. But you lose flexibility. Investments can be redirected, but mortgage payments are fixed. 6. Great emotional relief. Reduces financial stress. But emotional security may come at the cost of lower financial growth. 7. It's a form of forced discipline. Once paid, it's done. But that same discipline could be applied towards consistent investing with potentially better results. 8. Mortgage-free living is excellent for retirement planning, but you may enter retirement house rich, but cash poor if you don't build liquid investments. 9. No more interest payments over the life of your loan. Saves you thousands, but inflation actually makes those future payments cheaper in real terms. 10. Simplicity. Once your home is paid off, you don't have to think about it again. But simplicity comes at the cost of opportunity. Investing requires effort, but it can grow wealth faster. Part 2. Investing extra money, say in the S&P 500. 1. Historically higher rates of return. The S&P averages 7 to 10% long term. But those returns aren't guaranteed. Markets can and do crash. Your money stays liquid and accessible, but easier access also makes it easier to spend unwisely. 3. Compounding growth builds a wealth over time, but compounding only works if you stay invested during downturns and emotionally tough. Now, talking about compounding growth, if you're still here and you feel this is helpful, I'd ask you to like this video and be one of this channel's first subscribers. This is a new channel. You could help me reach more viewers. Thank you. Number 4. It diversifies wealth beyond just your home, but it adds exposure to market volatility and potential losses. 5. Inflation works in your favor. If your mortgage rate is low, you invest at higher returns while paying off cheaper dollars. But if inflation spikes and markets lag, you may feel squeezed on both ends. 6. Flexible. You can adjust contributions as income goals change, but flexibility also means you may not stay disciplined. 7. Potentially build more wealth for retirement, but your mortgage still demands fixed payments, reducing retirement cash flow until it's paid off. 8. Investing keeps you engaged with financial growth, but the same engagement can turn into stress when the markets start to swing wildly. 9. Investments can provide dividends or passive income streams, but dividends aren't guaranteed and may be cut in downturns. 10. If investments outperform your mortgage rate, you come out ahead. But if they underperform, you've been better off paying down debt. Here are a few numbers to consider if you're leaning towards investing that extra money. March 10th, 2000, the tech-heavy NASDAQ reached just over 5,000. The dot-com bubble burst and started a 2.5-year downturn. October 9th, 2002, it bottomed out at just over 1,100, a 78% decline. It was a slow climb, and then we had the financial crisis of 2008. It took a total of 15 years to recover. It wasn't until April 23rd, 2015 before NASDAQ would make a new record. Again, more recently, 2022, we went from around 1550 down to 10.5. The NASDAQ lost 34% that year. It gained it back the next year, but that's 2 years of no returns. Now, the NASDAQ has been on a rocket ship since then. Since January 2024 till September 23rd, 2025, the day I'm working on this script, the NASDAQ is up 55%. But if you happen to be a NASDAQ investor in March of 2000 and hung in there past the past 25 years with all the positive gains in the last 10 years, your analyzed gain would only be 6%. If you had perfect timing and got in at the end of the financial crisis in February 2009, you'd see an annualized gain of 15%. But how about more recent, December 2022, the end of the most recent financial crisis? Well, you'd see an annualized gain of 30% and you'd be rocking. But if you put that money in today, look at that chart. How far is this AI boom going? Looks a lot like the dot-com bubble graph. No one knows the future, but we are in uncharted waters. Or you could take a balanced approach. Of course, it doesn't have to be all or nothing. Some people split the difference, paying a little extra towards the mortgage for security while also investing for growth. This way you balance peace of mind with long-term wealth building. This was my story. First, thanks for hanging around this long. My goal at 40 was to have my house paid off by 55. So I refinanced my 7% 30-year mortgage for 4.75% for 15 years. See, I burned my boats like Cortez did in 1519. I made a commitment to pay it off. At the same time, I started to increase my monthly investments. I didn't carry credit card debt at the time. My only debts I had were my home and my vehicles. Now, I did all this while making a mid-5-figure income. I didn't crack 100,000 to my 50s. Yet here I sit today at 61 with no debt and very secure retirement fund. I did it by basically living below my means, but that's one of my other videos. So what method should you use? The truth is, it depends on your goals, your risk tolerance, and what helps you sleep best at night. I can tell you this: whatever you do, start now, because your older self would thank you. So are you team payoff, team invest, or team balanced? Let me know in the comments. I'd love to see where everyone stands on this. If you'd like to learn how to make your money last all month, you can watch this. I'm Charles. This is One Life, Many Lessons. Thanks for watching. Now go live your best life.